All right, everyone, we've said this many times. For every action, there's a reaction. Consequences are inevitable. When the G7 confiscated Russia's assets, it was hailed as a great victory, with headlines praising the decision. It's easy to see why they thought it was smart. Taking your enemy's money and using it against them seems clever. However, this is actually very short-sighted, and the latest developments are a reminder that the world is watching. It's not just countries like China that are outraged. Even major players in the Middle East and OPEC leaders aren't happy about it. Reports suggest that Saudi Arabia has issued a threat to the West, essentially an ultimatum. If the Western powers seize Russian assets, the kingdom will sell off G7 bonds. This warning was specifically directed at EU countries. We've repeatedly said that asset seizures will have repercussions, especially from the global south. For instance, China has stopped buying dollar or euro assets, and now there are rumors that the Saudis are losing trust in Western bonds as well. They specifically mentioned debt issued by the French Treasury, which is alarming on multiple levels. Firstly, there's a growing decoupling between the West and the East. Europe and the US are trying to restore their industries domestically, bringing manufacturing back from China. This will be incredibly costly, particularly in sectors like semiconductors, where the West will have to spend vast amounts to counter China. China is currently leading the West in investments, with over $140 billion allocated. In comparison, America is investing $33 billion, and the EU is expected to spend $46 billion. These amounts will only continue to grow over time. This isn't a one-time expenditure. The West will need to funnel hundreds of billions, if not trillions, more. But where will this money come from? Obviously, they need to borrow it from investors worldwide. Raising debt is essential for the West to build up their industries and challenge China. Confiscating Russian assets was a reckless move, as Saudi Arabia's warning has proven. The world is now wary of lending money to the West because asset seizure is a real risk. If fewer countries invest in Western bonds, it will drive yields up and make borrowing even more expensive. This will hinder their ability to compete economically with China, whose borrowing costs are effectively 50% cheaper. The situation worsens when you consider that Janet Yellen is defending the asset seizure. She might think it's a reasonable decision, but not all countries share that view.
There is no sense at all in which it's theft. The Russian assets remain in this institution. They've been impounded. The investments that Russia had have matured, so Russia's funds are sitting in cash, but they're generating income for the institution, which Russia has no claim on. So there's no legal issue here.
Let's get to the truth and separate fact from fiction. If Saudi Arabia dumps its euro or US bonds, will it immediately destroy the Western bond market and cause a major debt crisis? Firstly, Saudi Arabia has been selling off US treasuries over the past 4 years. Their holdings peaked at $184 billion in 2020, but by June last year they had decreased to just $8 billion. It's important to understand that the US Treasury market is enormous, valued at $27 trillion. To significantly impact it, a massive amount of bonds would need to be dumped. Even selling an additional $100 billion might cause yields to spike temporarily, but it definitely wouldn't collapse the entire system. Similarly, although Saudi Arabia holds tens of billions in EU bonds, this amount is still insufficient to crash the European bond markets. The real damage lies in the symbolism and the signal it sends to the world. It shows that the world's largest oil producer is no longer investing heavily in U.S. debt. Instead of focusing on U.S. bonds, Saudi Arabia is allocating its resources elsewhere, spending much more than it is saving. Their current account surplus has been dropping since the 2000s, and over the next 4 years they are expected to be in a deficit, despite being a major oil exporter. This means the kingdom won't have any dollar surplus left to recycle into U.S. bonds. More significant is tracking where Saudi Arabia is actually investing its money. Instead of buying Western bonds that could be devalued or confiscated, MBS is being more practical. He is borrowing money to invest globally, purchasing companies, mining assets, and real stores of value, things that hedge against inflation and make the country less reliant on oil and gas. For example, the Saudis are investing in Chinese green technology. Their investment arm recently signed a $5.6 billion deal with Chinese EV producer Human Horizons. They are not buying bonds held in Western countries that are at risk of being seized. Instead, they are diversifying their investments worldwide, especially in BRICS countries. The real risk Saudi Arabia poses to the dollar and U.S. bonds lies in how they price their oil. Currently, the dollar accounts for the majority of global trade and export invoicing. In the Americas, it's around 96% of trade. In Europe, it's over 70%. And in the rest of the world, including Asia, it dominates as well. However, China and Russia have been gradually undermining this dominance. Russia, as a major oil exporter, and China, as the world's largest manufacturer, are accepting local currencies in trade, helping to reduce the world's reliance on dollars. If fewer dollars are needed for transactions, there is naturally less demand for U.S. treasuries and euro bonds. Emerging countries can simply print their own currency to buy oil from Russia and goods from China, bypassing the need for dollars. This is the real Achilles heel of the dollar system. Therefore, it's crucial to pay attention to the steps Saudi Arabia is taking. Modern diplomacy recently highlighted a significant development: the birth of the petro-yuan, as Saudi Arabia joins the M-Bridge CBDC system. This is a consequential step for the kingdom as it seeks to break free from the dollar and Western currencies. The M-Bridge system effectively conceals the identities of both buyers and sellers, allowing Saudi Arabia to sell oil to China or any other country using alternative currencies, such as the Saudi Riyal, Chinese Yuan, or Indian Rupee. Because this system operates on a private ledger, the U.S. cannot determine whether transactions are conducted in dollars or not. It's a big black box. Additionally, there's the expansion of BRICS. Countries like Thailand, Malaysia, and Turkey are all seeking membership. There's a clear reason behind Putin's efforts to engage with nations like Vietnam and Kazakhstan, to create a larger network of countries willing to bypass the reserve currency. Commodity trade, especially in natural resources controlled by BRICS nations, provides the easiest avenue to begin de-dollarization. These resources are essential for the entire world, making this a strategic move to reduce dependence on the dollar. Oil is the largest commodity market in 2022. 2 years ago, it was already valued at $2.1 trillion, surpassing the combined worth of iron, gold, and copper 3 times over. Saudi Arabia alone accounts for over 40% of global production and a third of consumption, highlighting the significant amount of oil available outside Western markets that can be traded in currencies other than dollars and euros. The goal is to encourage countries, including Saudi Arabia, to price their commodity exports in non-dollar currencies. Even the IMF acknowledges that payment systems and the oil trade will undergo permanent changes.
If you asked me today about does this imply the imminent demise of the dollar, I would say flat out no. But that is not the case. But what we are seeing around the world is increasing fragmentation of payment systems that probably will further increase following this war. We are certainly seeing changes to global trade. For a fact, we know that energy trade will never look the same again after this war. And we are likely to see some countries, reconsidering how much they hold of certain currencies in their reserves.
Saudi Arabia dumping Western bonds is more than just a political statement. It signals to the world that U.S. and Euro debt are not good financial investments. Earning a 3 to 5% yield on bonds is not worthwhile. If it were, the Saudis would be aggressively buying up debt to build their wealth, but they are not. The reason is simple. The rate of inflation is higher than the returns on these bonds. If you think we're heading back to 2% inflation before the Fed cuts rates, think again. In the latest Senate hearing, Fed Chair Powell revealed his concerns mentioning that holding rates higher for longer could jeopardize economic growth in the U.S. In other words, the U.S. economy is struggling, jobs are at risk, and to combat inflation, the Fed might lower rates before inflation hits 2%. This would undermine the demand for U.S. bonds, leading to a new inflation crisis, and countries would prefer to invest elsewhere. Another serious problem facing global investors is the U.S. debt situation. Consider this: deficit spending is around 6% of the national GDP. As the conflict in Ukraine continues and the trade war with China escalates, this burden will become increasingly unbearable. More money will be borrowed for government spending, which is alarming given the IMF's warnings to Congress that the debt crisis could reach 140% of GDP by 2032. This is unsustainable and brings the possibility of an eventual default closer. When that default comes, there's one magic solution to remember. The dollar is our currency, but it's your problem.
Are U.S. Treasury bonds still safe to invest in?
Very much so. I think this is not an issue of credit rating. The United States can pay any debt it has because we can always print money to do that. So there is zero probability of...
You might get back the nominal amount, but the Fed will print a bunch of dollars to pay you back. However, the buying power of the currency is a different matter. This is why the G7 confiscation was a bad move for both Europe and the U.S. There is already an inflation problem and a debt crisis. The last thing you want to do is introduce geopolitical risk. Saudi Arabia dumping Western debt is significant, not because it will destroy the bond market tomorrow, but because of the symbolism. It signals that the Middle East is losing trust in Western governments. Seizing Russian assets was also outrageous and reminded the world of counterparty risk. Coupled with endless deficit spending, even if the West doesn't confiscate your assets, a default is inevitable. This is a serious issue with no escape.
The level of debt that we have is not unsustainable. The path that we're on is unsustainable. That's completely non-controversial. I would have thought that this is something that should be a top-level issue, and you do hear this from a lot of elected officials, but it should be a real focus going forward, is how do we get back to a sustainable path? Because you can't run these kinds of deficits in good economic times for very long. I mean, I wouldn't say, I can't really speak to the time, but in the longer run, we'll have to do something sooner or later, and sooner will be better than later.
This is the end game, folks. Pick your poison: asset seizure, confiscation, inflation, or maybe even both. It's no wonder central banks are offloading their bonds. Countries like Saudi Arabia and China have read the signs. As always, I'm interested in your thoughts. Will Saudi Arabia sell off everything? And can the West bounce back from this unprecedented asset seizure? Let me know in the comments below. Stay safe, and remember to like, subscribe, and join us as we navigate through these turbulent times. Thank you for watching.